We are Group 9, and we are doing the Vnu Lbo. My name is Cade Burnham.
My name is Thomas Verreke.
Stacy Heyer.
Skylar Humphreys.
All right, so first we're going to do a brief description about VNU. They're a global information and media company. Their total revenues in 2005 were 3.5 billion euros. And the rationale behind the transaction was that both the supervisory and executive boards of VNU felt that it was in the best interest of the shareholders and all of the stakeholders of the company to accept the offer made by this consortium of LBO funds. They were actually, I'll read a couple quotes. They said, based on long-term and careful analysis of various alternatives, including remaining in standalone company and breaking up the company, we concluded that this transaction best serves the interests of VNU's shareholders, clients, and employees. That was Jacobs, who's the chairman of VNU's supervisory board. He also said, the all-cash offer provides shareholders with an attractive price that fully reflects the independently assessed fair value of the company. And then Rob Vanderberg, who's the CEO of VNU, said, this transaction brings VNU new owners who support our long-term strategy of growth through expanded market coverage, expansion into developing markets, technology and service innovation, and development of integrated business solutions for our clients. It gives the company the added operational flexibility of private ownership. VNU will continue to focus on improving efficiency and integration across our business to ensure that we capture the substantial growth opportunities made possible by our business model and strategy. The consortium of LBO funds involved in the purchase of VNU were Alp Invest Partners NV, the Blackstone Group LP, the Carlyle Group, Hellman and Friedman LLC, Kohlberg Kravis Roberts & Co. LP, Thomas H. Lee Partners LP. Both transaction funding as well as financial advising was given to the LBO consortium by JP Morgan, ABN AMRO Bank, Dutch Bank, Citigroup, and ING. VNU also hired financial advisors for themselves to help them set a fair share price for the LBO. These groups included Credit Suisse, Evercore Partners, and NM Rothschild & Sons.
The acquisition of VNU was settled with a consortium that goes by the name of Valcon LLC on May 26, 2006. This was a highly leveraged transaction with massive amounts of debt. The consortium used roughly 8 billion euros of debt with only 631 million euros of cash. This resulted in an aggregate value of 8.6 billion euros or $10.3 billion, including the amount of debt. Valcon made an offer of 13.4 times the EBITDA for 2005. The interest rate for the debt was never made public, but to just give you a rough idea of how much debt was introduced to acquire the company, we can look at the interest expense before and after the acquisition. When we look at the financial statements from 2005 and 2006, we see that the predecessor paid $130 million for just 2005 alone. The successor paid $372 million in just the amount of time from May 24th, 2006 to December 31st, 2006. That is almost 6 times the amount of interest expense the predecessor was paying in the previous year. The agreement stated that one condition was that 95% of VNU shares were to be tendered. A press release on June 9, 2006 stated that a post-settlement was reached, saying that 98.97% of shares were acquired. This came to 254,003,484 ordinary shares and 1,667,171 American depository shares, each representing one ordinary share. Additionally, 149,704 preferred shares were tendered, representing 99.8% of outstanding and issued 7% preferred share capital of VNU. Another condition under the agreement was to hire a new CEO with the same outlook that was in line with Valcon's vision for the new company. Valcon reached out to Dave Calhoun, the vice chairman of GE, for this position, which he accepted 2 months later in July 2006 and remained there until 2013.
The consortium put a price tag of 7.6 billion euros or $9.10 billion on the enterprise value of the company. They pay 28.75 euro or $34.20 per common share. The outstanding shares are 264.5 million. The consortium also valued the company based on the 2005 EBITDA, which was 587 million euro or $705 million. They used a multiplier of 13.4, which is actually very high if you compare it with the normal multiplier of 10 to 12 in an LBO transaction. They used a higher multiplier because they saw a lot of growth for the EBITDA in the future. The transaction also involved the purchase of 7% of the preferred shares at 13 euro or $15.6 per share. The total amount for this purchase of preferred shares was 2 million euros or $2.4 million. The consortium also took over the debt of VNU, which led to a total transaction of 8.6 billion euros or $10.3 billion. If we look to the sources of funds, we see that the typical LBO transaction is with a lot of debt to leverage the returns in the future. The transaction of 7.6 billion euros exists out of two sources of funds. The first one is 3 billion euro or 40% of the transaction, which is carried by the consortium of the 6 private equity firms. The other source of fund is debt. The total debt is 4.6 billion euro and is carried by a consortium of investment banks. These banks are also the banks who gave financial advice. As we can see, the amount of debt in the transaction is 60%, which is in the range of 60 to 70% of debt used in the typical LBO transaction. The normal multiplier of debt used in an LBO transaction is 5. With an EBITDA of 587 million euros, we have a multiplier of 7.83. This is higher than normal, but the risk is divided by 5 different investment banks.
The company deleveraged from 9.1 to 3.5 between 2006 to 2013. Nelson's focus has been to drive shareholder value through consistent growth, profitability, and free cash flow. By doing this, they were able to reduce the company's debt. They doubled EBITDA and reduced their leverage ratio an additional 0.5% per year. By focusing on investing in growth opportunities, they have increased revenue compound annual growth by 5% and increased margin by 400 basis points expansion from 2008 to 2013. Dave Calhoun joined Nelson in 2006 after his position as vice president of GE. Shortly after joining the company, Nelson was acquired by a consortium of private equity investors, including Blackstone. Dave led the transformation of the company into a leading market information services company in the world. Under Dave's leadership, Nelson's operating income improved from $0.8 billion at the time of the acquisition to $1.7 billion in 2012, with a compound annual growth rate of 13%. In 2011, the company issued an IPO. The company was selling 21% of itself, where all of the money from the offering would be used to pay down Nelson's $8.6 billion debt load from the LBO. They expected Nelson's equity to be worth $7.3 billion after the deal. This past October, Nelson's reported their third quarter 2015 results. Revenues were $1,531 million for the third quarter of 2015, down 2.6% due to the impact of foreign exchange. This marks the company's 37th consecutive quarter of consistent currency revenue growth. Adjusted EBITDA for the third quarter increased 0.4% to $470 million. Net income for the third quarter increased 54.3% to $142 million. As of September 30th, 2015, cash balances were $358 million and gross debt was $7,453 million. Net debt was $7,095 million and their net debt leverage ratio was 3.83 at the end of the quarter.